what I do when the stocks keep going down. Over these last few weeks, the stock market has been dropping pretty steadily, and it's not showing any signs of slowing down, but we had a green light yesterday and today, and I'm getting quite happy. What does this mean? Is it time to just pack up and leave the market? Hello everyone and welcome back to my channel. My name is Tony. Before we begin, I just want to remind you to give the video a like and share it with your friends if you enjoy my content. And go ahead and subscribe if you haven't done it yet to make sure you never miss an upload. Alright, now let's talk stocks. Most stocks took a hit, especially most of the interesting growth and spec stocks out there. I had a little hit, especially with NEO and Canadian Solars. Tesla only a little bit, just because I start buying it a little bit, adding to my positions in October and November, and a little bit in February. As you know, I have been buying Tesla since 2018, so I'm enjoying a very good profit. So why is this happening? To put it simply, because we aren't the only people on the market. Every little action that every investor takes affects the overall situation. And so, with the bond yields going up, the market trying to correct itself, and all of this talk of inflation, people were going to be worried. To top it all off, Federal Reserve Chairman recently announced that they will not be raising interest rates. What did people take away from his statement? Inflation is coming. Time to panic. But there is the thing. We've been seeing inflation all around the market for the last year. And if you are into real estate, you know that it's been happening there as well. Alright, but why exactly now? For inflation to really kick in, money needs to move around fast. In the financial world, this is called velocity of money. And it comes with its own fancy formula, backed up by a ton of data and theories. What we have? Lockdowns? That's it what? People were discouraged from going out and spending their own money because a ton of stuff is just not available or difficult to do. Think like restaurants, vacation, movie theaters, concerts, cinemas. Since people can't spend their own money where they want, they are just saving it. And JP Morgan confirms this by pointing out that US household savings have gone up by over $1.5 trillion for last year alone. But what will happen once we finally put all of this lockdown stuff behind us? Well, people are obviously going to go out and do what they've been wanting to do. And since they've had to wait for more than a year, they're going to want to do them fast. This means that a lot of money is going to change hands really, really fast. Then there is also the whole stimulus things that's happening over in the US, where over $1.9 trillion will hit the economy. And by hit, I mean inject another $1.9 trillion into it. So the lockdowns are, in a way, keeping the inflation bay for now at least. Of course, I'm not saying that lockdowns are a good thing, because they are also one of the main reasons we even got to this situation in the first place. Lately, there has been a lot of talk about loosening restrictions and potentially returning to normal by the end of the year. But while people were looking forward to going back to living their lives like they wanted to, and businesses are planning to finally get back on track, investors are getting increasingly worried. In 2020, both the real estate and the stock market managed to hit record highs, not just because people were scared, but also because they didn't have anything else to do with their money. And we've already seen inflation in both of these fields, so even if you haven't thought about the bigger pictures, it's only natural to expect that it will spread over to the rest of the economy. Let's talk about bonds and inflation. Bonds serve as a sort of warranty. 1.5% bond yields mean that after you buy, you are guaranteed to get 1.5 return on your investment every year. But if investors are worried about inflation, 1.5 just doesn't cut it. If the inflation is higher than the bond percentage, people will lose value of their money over time. And well, nobody wants that. So nobody buys bonds. But if nobody buys bonds, the yield goes up. Supply and demand, very basic stuff. Here's how it works. Investors worry about inflation. Investors stop buying bonds. Bond yields go up. Investors start buying bonds again. Bond yields are directly tied to inflation projections. The higher inflation people expect, the more bonds need to yield. If you take a look at the history books, you will also notice this pattern. Back in 1991, when inflation was at about 12.5%, bond yields managed to hit 15.30%. Why is this affecting the stock market? If bonds go up to, let's say 10%, people would get a guaranteed 10% return on their money by making a risk-free investment. But the money put into bonds is money that's not put into the stock market. So the stock market directly suffers as a result of people buying bonds. Inflation, projections go up. The price of bonds goes up. People pull their money off the stock market to put into the bonds. The stock market suffers. Additionally, there is like a ton of people out there who are 100% convinced that the 10-year yield, Treasury yield 10 years, TNX, leads the Federal Reserve's interest rate. When they see the bond yield going up, they automatically assume that the Fed will raise the interest rate. Remember how I mentioned it, that the Fed chairman said how they are not going to raise interest. Well, this same announcement made the bond yields go up and the market go down even more. How do interest rates affect the stock market? Don't stocks love low interest rates? Well, yes, but also no. In general, low interest rates are good for investors because money is a lot more accessible. But this accessibility also speeds up inflation. The real estate market is hitting record heights precisely due to the low interest rates. Low interest rates cause more inflation. Inflation makes bond yields go up. Bond yields going up makes the market go down. So what does this mean for the stock market? If the interest rates stay low, the market suffers. If the interest goes up, the market still suffers. Does this mean that the stock market is completely finished? Of course it's not. The market had a fantastic run and now it's time for corrections. This is all normal. And no matter what the Fed chairman said, the stock market was going to react poorly. What I'm doing right now? I'm doing exactly what I always advise people to do. I'm keeping an eye on the prices and waiting for good opportunities to jump in and buy even more. I will continue with my strategies for as long as I still believe in the companies. If I lose faith in them, I will find new, better investment targets. Of course, I'm being very careful. I don't like being overly aggressive with my purchases, even in the best of times, and I want to see some really good deals before I start buying more aggressively. Besides, I strongly believe that every long-term investor should hold on to a solid cash position. Throwing everything you have into the stock market is all sorts of silly and will only lead to problems down the line. If you have been following my channel for some time, you've probably heard me talk about this over and over, but I will leave a couple of links for you down in the description just in case you missed it. Let's wrapping it all up. So let's wrap things up for the day with a short summary. Stocks are not just some random numbers in your spreadsheet. Every stock on the market represents a real business, staffed and run by real people. When the price goes down, the valuation for the entire company goes with it. When the valuation goes down, they need to produce less earnings to meet their price to earnings ratio. When the stock goes higher, the business needs to perform much better to justify the price. No, it's not over for the stock market. Yes, there is inflation, and it's reasonable to expect even more inflation down the line when everything's open up. Yes, inflation will mess with the bonds and the stock market. No, there is no reason to panic. Yes, I expect more dips. No, I'm not buying aggressively. Investing is safer when stocks are cheaper. Investing is riskier when they are more expensive. Keeping cash on hand allows you to take advantage of the big dips when they happen. The market is correcting itself right now. The bond yields are going up, and there is a lot to talk about inflation. And while you guys may not be too worried about it, the average investor will be. So, I really hope that giving you this little short video here about bonds, inflation and stock market, you guys can have a little idea of what is going on the market. And I'd like to really say a big thank you for spending your time watching my videos. It really means a lot for me. So if you can just press this button, like, share with your friends, comment down below and let me know your opinion. I would love to hear from you. I just want to say one thing. I'm not a financial advisor, and I really want you to do your own research. Think before you buy and do it in increments. Don't be overly aggressive with your purchases unless the situation really calls for it. Now I know that there is a lot to talk out there about a potential big crash sometime down the line. And well, for all we know, that could happen. But that is precisely why I always tell people to not put all of their money into the market. If you're a long-term investor, you should be looking at your position as long-term assets. When I find a business that I believe in and I decide to buy shares, I don't count my position as available money. I do not want to pull out of my positions unless I somehow lose faith in the company. That is also why I keep going on and on about financial stability, budgeting, and on the long-term investing mentality. If you want to do well on the stock market, in the long term, you need these things. Whatever happens with the market, it will eventually correct itself. Patience and stability is all you need. And again, if you enjoyed this video, please do not forget to give it a thumbs up and share it with your friends. This really helps with the YouTube algorithm, and it also lets me know that I'm doing a good job helping people out with their stock market career. Now, thanks for being with me, and till next time, stay very motivated.